All right, so are you ready to dive into the world of Peter Lynch? You might know him as the guy who led Fidelity's Magellan Fund to like a legendary success.
Yeah,
But what's really cool is that he believes anyone can learn to pick winning stocks.
absolutely.
No fancy finance degree required. We've got excerpts from his book, Beating the Street, plus some real-life examples of how his strategies actually played out.
It's true. He had this knack for making investing feel approachable, you know?
Yeah,
He'd take CEOs out to lunch to get insights.
right.
Not exactly your typical Wall Street move, but
Yeah,
before we get into those juicy stories,
yeah.
let's address a common misconception.
Okay.
Some people think Lynch was against mutual funds,
I've heard that too.
but that's not quite right, is it?
Definitely not. He saw them as a fantastic option, especially for folks who want in on the stock market action but don't have the time or maybe the desire to like deep dive into research themselves.
He likened it to owning a slice of an entire industry through a single investment, a great way to diversify without having to pick individual stocks.
Right.
But he wasn't saying mutual funds are the only way to go. In fact, he believed you could do both.
So it's not a case of one or the other, more like different tools for different goals.
Right.
But he did have a big caveat about mutual funds, right? Something about not jumping in and out all the time.
Exactly.
Okay.
Lynch was all about the long game.
Yeah.
He warned against trying to time the market,
Right.
jumping in when things are hot and bailing when they cool down.
Yeah.
Instead, he advocated for a steady hand and a long-term perspective, letting those investments ride out the market's inevitable ups and downs.
I feel like that's such a hard lesson for many investors,
Oh, yeah.
myself included.
Yeah.
We always think we can outsmart the market.
We all do. Yeah.
But Lynch seemed to have a different approach.
Oh, absolutely.
Okay.
Speaking of different approaches, you've got to hear about the St. Agnes School miracle.
Oh, yeah?
This group of 7th graders built a stock portfolio that actually beat the experts.
7th graders. Okay, I need all the details on this one.
Well, they followed some of Lynch's core principles,
Okay.
like focusing on companies they knew and understood.
Right.
Think about it. You don't need a Wall Street analyst to tell you if your favorite sneakers are flying off the shelves, right?
That's so true. They had firsthand insights into what was popular and what was actually working in the real world.
And they weren't afraid to do their research.
Right.
They looked into these companies, figured out how they made money, and made thoughtful decisions about where to invest.
It's like they were mini Peter Lynches in the making. It kind of proves his point that you don't need a fancy degree or some secret formula to find success in the stock market.
Right. It's about paying attention, doing your homework, and making smart choices.
Yep.
And another crucial factor, consistency.
Okay.
Those St. Agnes students didn't just buy stocks once and forget about them.
Yeah.
They invested regularly, even with small amounts, and that consistency really paid off.
So it's not just about picking the right stocks. It's about building that habit of investing steadily over time.
Exactly. And there's this mind-blowing calculation Lynch highlights in his book.
Okay.
If you had invested just $1,000 in the S&P 500 back in 1940 and just left it alone, it would be worth over $300,000 today.
Hold on. Over $300,000 from just $1,000. Seriously.
Seriously. And get this, if you added another $1,000 to that investment every year,
Oh, wow.
well, that same investment would be worth over $3.5 million today.
Okay.
That's the incredible power of compounding returns.
Yeah.
Your money is essentially making more money, and that growth just keeps building on itself.
Okay, that's wild.
Yeah.
It really drives home the point that even if we aren't picking individual stocks like Peter Lynch, consistently investing in a diversified fund can lead to incredible results in the long run.
Couldn't agree more.
Okay.
But let's get back to Lynch and his unique approach.
Right.
He was all about doing your own research, but not in the way you might think.
Okay.
Forget spending hours poring over spreadsheets.
Yeah.
This was about truly understanding the businesses behind those stock pickers.
Right. He believed in getting out there and seeing those businesses firsthand.
Yeah.
Remember that story about him taking the CEO of Union Carbide to lunch? I mean, who does that?
He was bold, but it goes to show that he wasn't afraid to get personal and gather those insights directly from the source.
Right.
He wanted to understand the company's story, its culture, its competitive advantages, things you can't always find in a financial statement.
So it's more about the qualitative side of investing, the stuff that doesn't show up in the numbers but tells you a lot about a company's potential.
Exactly.
All right.
And he wasn't expecting every company visit to be a gold mine.
Right.
He said even if only 2 out of 10 encounters reveal something truly insightful, that was enough to give him an edge.
Uh-huh.
It's about those little nuggets of knowledge, those aha moments that can really inform your decisions.
It's like detective work for stocks. So besides actually talking to the CEOs, what else did Lynch look for when evaluating companies?
Well, this is where it gets interesting.
Okay.
He had some unconventional criteria,
All right.
things that wouldn't necessarily show up on a balance sheet.
Mm-hmm.
For instance, he preferred companies that avoided taking on mountains of debt.
Okay.
He figured a company that's drowning in debt is less likely to weather a storm or be able to invest in its own growth.
Makes sense.
Right?
What else?
He also liked companies that treated their employees well.
Interesting.
His reasoning was happy employees are often more productive and loyal, which translates to a stronger company culture and, ultimately, a better bottom line.
That's an interesting point, but is it always possible to find companies that are both profitable and ethical? I mean, there are plenty of companies out there that are incredibly successful, but maybe not known for their stellar treatment of employees.
That's a valid question.
Yeah.
And it's a debate that's still going on today.
Right.
But Lynch believed that a company's values ultimately impact its long-term performance. He looked for companies that were doing things the right way, treating their people well, and building a sustainable business model.
So it sounds like he was looking for companies that weren't just focused on short-term profits, but were building something for the long haul.
Precisely.
Okay.
He also had a thing for companies that found niches that bigger companies often overlooked.
Interesting.
He figured these smaller players could often fly under the radar,
Uh-huh.
quietly building successful businesses in those less competitive spaces.
Like finding those hidden gems that no one else is paying attention to.
Yeah.
Do you have a good example of that?
Oh, absolutely.
Right about.
Remember Shaw Industries, the carpet company we mentioned earlier?
Uh-huh.
They became a billion-dollar success.
Wow.
Not by being flashy or trendy,
Right.
but by focusing on being the low-cost producer in a notoriously tough industry.
Okay.
They were incredibly efficient, innovative, and laser-focused on keeping their costs down.
So instead of trying to be everything to everyone,
Right.
they found their lane and absolutely dominated it. Exact. I started to see a pattern here.
Yeah.
Lynch wasn't looking for the most piped-up companies. He was
Right.
looking for solid, well-managed businesses with strong fundamentals.
You're getting it. He wasn't swayed by hype or flashy trends. He
Yeah.
focused on substance, companies that were quietly building strong businesses.
Okay.
And speaking of hype,
Yep.
we all know the financial markets can be a real roller coaster of emotions.
No, tell me about it.
It's easy to be caught up in the ups and downs.
Oh, yeah,
All those swings can make anyone's stomach turn.
for sure.
And it can lead to some pretty bad decisions when you're letting fear or greed take the wheel.
That's where Lynch's concept of the weekend worry trap comes in, right?
Yeah, that's it.
You know, that anxiety that can creep in after a week of market ups and downs,
Right.
making you question everything
Yeah.
and second-guess your investment strategy.
Yeah.
So what exactly is this weekend worry trap? I feel like I've definitely fallen into it before.
It's that feeling when you're constantly checking the market, reading every headline,
Right.
and letting the news cycle dictate your investment decisions.
Yeah.
Lynch even talked about how he experienced this himself.
Oh, really?
When participating in the Barron's Roundtable, where even seasoned professionals would get caught up in worrying about the latest economic indicators.
So it's not just us regular folks who get sucked into that vortex of worry.
It happens to the best of us.
Even the pros fall prey to it.
It happens to the best of us.
Wow.
But Lynch's message is clear.
Okay.
The person who ignores the noise and stays focused on their long-term investment plan often comes out ahead.
I like that.
It's about tuning out the daily chatter and focusing on the fundamentals of the businesses you believe in.
I love that. It's a great reminder to step back from the constant stream of information and focus on the bigger picture.
Exactly.
So did Lynch have any specific examples of companies where this long-term ignore the noise approach really paid off?
Oh, absolutely.
Okay.
Get ready for some fascinating case studies.
All right.
These stories really highlight the diversity of Lynch's portfolio
Okay.
and the sometimes surprising factors that influenced his decisions.
Okay, hit me with those unexpected details. I'm all ears.
Let's start with Fannie Mae.
Okay.
This company played a crucial role in the housing market, and Lynch had immense confidence in its long-term prospects, even during times of economic uncertainty.
So he was really bullish on Fannie Mae.
He was.
Yeah.
He believed the housing market was fundamentally sound
Uh-huh.
and that Fannie Mae would be a key player in its continued growth.
So while others were panicking, he was looking at the bigger picture, seeing an opportunity where others saw only risk.
Exactly.
That's pretty impressive.
Exactly. Then there's the wild story of Volvo.
Okay.
Lynch took a trip to Sweden
Uh-huh.
and discovered that the company was so incredibly undervalued
Wow.
that investors were essentially getting the entire auto business for free when they bought the stock.
Wait a minute, the whole business for free? How is that even possible?
It was a rare situation where the market had completely mispriced the company's assets and its future potential.
Okay.
It's a classic example of Lynch's ability to find hidden value where others just saw a struggling company.
He had a knack for seeing what others missed. Okay, I'm dying to hear more of these case studies.
Right.
What else did he unearth?
Well, sometimes the best investment insights come from the most unexpected places.
Oh, yeah.
Take the body shop, for instance.
Okay.
Lynch's own daughter's shopping habits, combined with his observation of a consistently crowded store at the mall, sent a powerful signal.
Really?
He saw firsthand the popularity of the brand
Okay.
and realized the company had something special.
Uh-huh.
This led him to invest, and it turned out to be a big winner.
So paying attention to what people are actually buying
Exactly.
and not just what the experts are saying
Yeah,
can be a valuable research tool.
absolutely.
It's like real-world market research in action.
You got it. And then there's Walmart, a company that already had a significant track record of success.
Mm-hmm.
But Lynch's investment in Walmart demonstrates that even a stock that's already gone up significantly can continue to grow if the underlying company hasn't reached its full potential.
So the key is to look beyond the stock's past performance and really dig into the company's future prospects.
Yeah.
What did he see in Walmart that others might have missed?
He saw that Walmart had this massive runway for expansion.
Uh-huh.
They were relentlessly focused on customer satisfaction,
Right.
constantly innovating and offering incredibly low prices.
Okay.
He recognized they hadn't even come close to saturating their market,
Right.
which meant there was still enormous potential for growth.
It makes you wonder what hidden gems are out there right now,
Yeah.
just waiting to be discovered.
That's the exciting part, isn't it?
Yeah.
There are always opportunities out there for those willing to look.
Look.
But here's the thing.
Okay.
Lynch wasn't just about chasing the obvious winners.
Uh-huh.
He had this incredible ability to find value in places that most investors wouldn't even consider.
Okay, now you really got me intrigued.
All right,
Tell me more.
you ready for this? One of Lynch's most surprising strategies was his belief that even lousy industries can contain great companies.
Wait, hold up.
Yeah.
Lousy industries?
Yeah.
That sounds kind of counterintuitive.
Yeah.
Why would anyone invest in a sector that's, well, lousy?
It's all about looking beyond the industry's reputation and digging into the individual companies.
Okay.
Lynch argued that some of the best opportunities are hidden in plain sight, tucked away in sectors most investors avoid like the plague.
So, like under the radar, kind of.
It's like finding a diamond in the rough. You got to be willing to sift through the dirt to find those hidden gems.
So it's about looking for those companies that are thriving despite their industry's struggles. The ones that are doing things differently and defying the odds.
Exactly. You've got to look beyond the headlines and focus on those companies that are winning even when the tide is turning against their entire sector.
Okay, I'm all into this idea of finding hidden gems in unexpected places. Do you have any juicy examples of companies Lynch invested in that fit this mold?
Oh, you know I do. Let's talk about Green Tree Financial,
Okay.
a company that specialized in mobile home mortgage loans.
Okay.
Now, this industry was in decline,
Yeah.
with sales dropping year after year.
Not exactly the hottest ticket on Wall Street.
Right.
So what did Lynch see in Green Tree that everyone else was missing?
He saw a company that was defying the industry trend.
Okay.
Green Tree was dominating its niche,
Uh-huh.
expanding into new areas,
Right.
and running its operations with incredible efficiency.
Okay.
They weren't just surviving,
Yeah.
they were thriving.
They found a way to win even when the game seemed rigged against them.
Right.
That's pretty impressive.
It is. It shows that even in a struggling industry, there are companies out there that are finding ways to innovate, adapt, and come out on top.
Right.
And here's another example that might surprise you, Crown: Cork and Seal.
Okay.
Now, can making might not sound like the most glamorous industry.
Yeah, no.
But Crown, Cork and Seal managed to become the world's most successful can maker.
Really?
How? By being absolutely relentless about keeping their costs low.
So they weren't trying to reinvent the wheel. They were just focused on doing what they did better and cheaper than anyone else.
You got it. They were masters of operational efficiency, squeezing every penny out of their processes and constantly looking for ways to improve.
Okay.
They were the ultimate penny pinchers, and it paid off big time.
It's amazing how companies can find success by focusing on those fundamental principles of efficiency and smart management.
Yeah.
It's like they're proving that slow and steady wins the race.
Absolutely. And sometimes it's the companies that are flying under the radar,
Right.
the ones that aren't chasing the latest trends that
Yeah.
end up being the most successful.
Right.
They're quietly building solid businesses,
Uh-huh.
focused on the fundamentals and delivering consistent results.
Right. Okay.
And a company that really embodied this was Golden West Financial,
Okay.
a savings and loan association that was incredibly successful.
Okay.
This company was run by a husband and wife team
Oh, wow.
who avoided all the trendy investments and stuck to traditional mortgages.
Sounds like they were going against the grain. What made them so different? What did Lynch see in them?
They were incredibly disciplined and laser-focused.
Okay.
They knew their business inside and out,
Uh-huh.
avoided unnecessary risks,
Right.
and maintained a rock-solid financial position.
Okay.
They even refused to install ATMs.
Really?
because they considered them an unnecessary expense.
Wow.
They were all about running a lean, efficient operation and providing excellent service to their customers.
It's a great reminder that sometimes the simplest approach,
Yeah,
the one that focuses on the core business and doing it well, can be the most effective.
for sure.
No need for all the bells and whistles.
It's a powerful lesson. And, it ties back to that idea of tuning out the noise and focusing on what truly matters.
Right.
These companies aren't swayed by the latest fads or trying to be everything to everyone. They knew their strengths, they stuck to their knitting, and they executed their plans flawlessly.
So what does all this mean for everyday investors like me? How can we apply these principles to our own portfolios?
Well, first and foremost, remember what Lynch said.
Okay.
Everyone has the brain power to make money in stocks.
Okay.
Not everyone has the stomach.
Right.
It's not just about having the knowledge. It's
Yeah.
about having the emotional fortitude to ride out the market's ups and downs and stick to your investment plan.
So it's about having a strong stomach, not just a sharp mind.
Yeah,
That makes sense.
yeah.
But how do we actually go about building that portfolio of well-chosen stocks?
Lynch had some great advice for that, too.
Okay.
He said, know what you own and why you own it.
Yeah.
It seems so basic, but it's so easy to get caught up in the hype or to chase the latest hot stock tip without truly understanding what we're investing in.
Yeah, we've all been there. So it's about doing our homework, understanding the business, and making sure it aligns with our investment goals and our risk tolerance.
Exactly. He also advised against getting involved with more stocks that you can handle.
Right.
He said the part-time stock picker probably has time to follow 8 to 12 companies and to buy and sell shares as conditions warrant.
Right.
You don't need a portfolio of 50 stocks to be successful.
It's about quality over quantity.
Exact.
Finding those few truly outstanding companies that you believe in and that fit your investment strategy.
Right. He even said there don't have to be more than 5 companies in the portfolio at any one time.
Wow, really?
Focus on your best ideas.
Okay.
The ones you have the most conviction in.
That's interesting. So it's really about having a concentrated portfolio of those companies you believe have the greatest potential,
Right.
not trying to spread yourself too thin or chasing every shiny object that comes along.
Exactly. And here's another piece of advice that might surprise you.
Okay.
Lynch believed that owning stocks is like having children.
Oh, wow.
Don't get involved with more than you can handle.
Ah, I love that analogy.
Yeah.
It's so true.
Right.
If you have too many kids or too many stocks, you won't be able to give each one the attention it deserves.
And lastly, don't be afraid to consider a global perspective.
Okay.
The U.S. stock market has done incredibly well historically,
Uh-huh.
but there are faster-growing economies around the world.
Right.
Lynch recommended allocating a portion of your assets to an overseas fund with a solid track record.
Okay.
This can help you diversify your portfolio and tap into the growth potential of different regions.
So don't be afraid to venture beyond your own borders. There are opportunities to be found all over the world.
Right.
I'm starting to feel like a global investor already.
That's the spirit.
Yeah.
But even with a global perspective, remember,
Yeah.
investing isn't just about picking the right stocks.
Mhm.
It's about having a sound strategy,
Right.
doing your research,
Yeah.
managing your risk,
Right.
and most importantly, staying the course.
Okay.
Even the best investors experience ups and downs.
Yeah.
But it's those who can weather the storms and stick to their plan that ultimately succeed.
This has been an incredible deep dive. I feel like I've gained a whole new perspective on investing, and I'm ready to start putting these principles into action.
Yeah.
But before we wrap up, I remember one more important point from Beating the Street.
Okay.
Lynch mentioned something about capital gain taxes.
Right.
And how they can actually hurt investors who are constantly jumping from one fund to another.
Right.
Could you elaborate on that a bit?
Absolutely.
Okay.
It's tempting to chase the latest hot fund.
Right.
But Lynch emphasized that switching too frequently can create a hefty tax bill.
Okay.
If you've invested in mutual funds that have performed well, there's no need to abandon them on a whim. Consistency and patience are key, just like with individual stocks.
Right.
Stick with your winners and let those returns compound over time.
Okay.
That way you'll maximize your gains and minimize your tax burden.
It's so tempting to chase the latest hot fund, but you're right.
Yeah.
Often the best approach is to stay the course.
Yeah.
I guess it's like that saying, if it ain't broke, don't fix it.
Exactly. It's about resisting that urge to tinker and tweak constantly.
Right.
Find a strategy that works for you.
Uh-huh.
Invest in companies you believe in.
Okay.
And then let time do its magic.
It all comes back to that long-term perspective that Lynch was always talking about.
Right.
He really had a knack for simplifying investing and making it feel accessible to everyone, not just the Wall Street elite.
He truly did. And, one of his most powerful messages was that
Okay.
in the long run, A portfolio of well-chosen stocks or equity mutual funds will always outperform a portfolio of bonds or a money market account.
But a portfolio of poorly chosen stocks,
Right.
well, that might not even outperform the money you leave under your mattress.
Aha, that's a great point. It all comes down to making informed decisions and having a solid investment strategy,
Right.
one that you can stick with through thick and thin.
Well, I don't know about you, but I'm feeling incredibly inspired to go out and apply these principles.
Yeah,
If you're like me and want to learn more from the master himself, I highly recommend checking out Peter Lynch's book, Deeding the Street.
absolutely.
It's packed with wisdom, insights, and those incredible real-life stories that we all love.
It's a must-read for anyone who wants to take control of their financial future and unlock the power of the stock market.
Thanks for joining us on this deep dive into the world of Peter Lynch.
Yeah, thanks for having me.
We'll see you next time for another fascinating exploration of knowledge and ideas.
Sounds great.
Until then, happy investing. It's so tempting to chase the latest hot funds, but yeah, you're right.
Yeah.
Often the best approach is to just stay the course. I guess it's like that saying, if it ain't broke, don't fix it.
Exactly. It's about resisting that urge to tinker and tweak constantly.
Right.
Find a strategy that works for you, invest in companies you believe in, and then just let time do its magic.
It all comes back to that long-term perspective that Lynch was always talking about.
Yeah.
He really had a knack for simplifying investing and making it feel accessible to everyone, not just the Wall Street elite.
He truly did. And one of his most powerful messages was that in the long run, a portfolio of well-chosen stocks or equity mutual funds will always outperform a portfolio of bonds or a money market account.
But a portfolio of poorly chosen stocks,
Right.
well, that might not even outperform the money you leave under your mattress, right?
Ha! That's a great point. It all comes down to making informed decisions and having a solid investment strategy,
Right.
one that you can stick with through thick and thin.
Well, I don't know about you, but I'm feeling incredibly inspired to go out and apply these principles.
Yeah, me too.
If you're like me and want to learn more from the master himself, I highly recommend checking out Peter Lynch's book, Beating the Street.
Absolutely.
It's packed with wisdom, insights, and those incredible real-life stories that we all love.
It's a must-read for anyone who wants to take control of their financial future and unlock the power of the stock market.
Well, this has been an awesome deep dive into the world of Peter Lynch. We'll see you next time for another fascinating exploration of knowledge and ideas. Until then, happy investing.